welcome everybody to this session on corporate growth. Venture capital has been the default method for startup funding, but recently we've seen other ways of innovative finance that will help founders find different and faster ways of raising capital without dilution. And today we have some of the most active debt investors in Spain and also in Europe. So I'm going to start with Ignacio. I think because you're the first one, you're going to have to describe what is debt funding. That's first of all. And then I would love to understand where are we in this transition? Like, what's the appetite for this change in traditional funding?
Okay. I mean, it's kind of open question, so I'll try to do my best. So obviously, so when you mean about debt, so it's kind of easy. So we give you money and you need to recover this money under the calendar. So it's as simple as that. I mean, the crazy thing here is that we are talking about companies that normally they lack historical patterns. So normally we are talking about companies that they are burning cash. So for that reason, in essence, it doesn't make sense to do what we do. Fortunate enough, we have the kind of companies that they have great sponsors, they have a great product, and they have a very important topic here, which is visibility. So they have great unit economics, so basically a product that works, and in essence, they are choosing to lose money, which is kind of crazy because they believe that if we grow very fast, it's going to add more value than just having a very profitable business in the old way, saying that just being able to pay without external funding. So in these kind of companies are the ones that potentially make sense to lend against that. And to the other question, basically, I think people and markets are developing more and more, meaning that people tend to be more sophisticated, they tend to think more about what is the optimal capital structure, and sometimes these sophisticated sponsors, VCs, even growth stage private equities, they believe that they are going to gain more value if they choose the debt path versus the former or the old equity path, which is in essence, what it makes sense most of the times. So probably that would be my open speech.
Your open speech. Jan, and following up on that answer, do you see that already being implemented, or you think that founders still lack the educational side of things to understand that this is a vehicle that they can use?
Okay, so from our side, we launched BBVA Spark 4 years ago. So we have been super active in these last 4 years. I would say even before we launched, the venture debt product was already quite well known. And in the last 4 years, it has continued to build as becoming a product which is pretty standard and which is considered by many founders when they do an equity round. So I think most of the market education has been already done. Also, we see more and more players in the market. We see more and more tech companies looking for this type of financing. And I think it can be a great product to, depending on the stage of the company, but in the early stages, to really complement equity rounds, maybe be a small complement, and when they continue to become much more mature, to become a very relevant part of the financing of the growth of these companies.
And from the investor's perspective, traditional VC funding gave you equity. How do you see that like changing for this new way? Like, what is the main value that you get?
So I think equity is still clearly equity is needed at the beginning of the company. You know, when you found a company, you need equity to develop the product, to find the product market fit, to build the initial team, to build so the foundations of the startup. But once you have that product market fit, once you start having high growth, and once you have strong unit economics, like Nacho mentioned, then that can be a very, very useful instrument to further scale the business, to have less dilution, and it can be a way to efficiently finance your future growth of the business.
Christy, you have been at Santander, you've been at BBVA, you're now the partner at Tempo Growth. You've seen it all.
Yeah.
I didn't know you were in Santander.
No, I was running actually Europe in capital business. I was head of Europe actually there for a while. And
There's always something that you learn.
And then founding Spark, one of the co-founders of Spark, and now here in the debt. And by the way, guys, I mean, if you see, this is a typical debt uniform. Do you see the trousers? So this is how it works. You have to have this in order to be a debt investor. Sorry.
Back from the side quest. I think my question for you is more for founders, so like some practical advice for them.
Yeah.
If they're at the navigating which funding to get, what are the 1, 2, or 3 things that they should really be looking at to understand what's best for them?
Okay. Well, generally speaking, I mean, I totally agree with the guys. You actually, it's not nice to have that. You have to have that at a certain point of your journey. So at the beginning, you need equity because there's nobody crazy enough to give you money if you don't have a product and you have a product market fit. So you have to prove actually your product. And after a while, you see, hey, this product works. Great. I make revenues. Well, I'm still EBITDA negative. I'm still burning a lot of money, but it seems to be working. If I grow after a year or 2, I can get to the level that where I'm going to be profitable. So this is the moment to get the money. Usually best when you when you have some kind of runway, so usually around the Series A, but you also can wait like 6 months later because I've been also a founder, I know how hard it is to raise money, and if you're in the equity round, you just equity, you cannot really see much about debt at the same time. But a couple of months later, you should definitely start to raise a debt round because this is the money that actually makes you grow. The money of equity is just to prove your point, to give you some credibility, and after a while, put that in because this is actually the gasoline that makes your business grow. But there's so many different kinds of debt. I mean, I'm doing asset-backed lending, I'm doing venture debt, I'm doing structured debt. There's so many things that you guys definitely do not know because you're not expert in this one. But I definitely will advise you to come and talk to us basically, which we know about this and we know which kind of product is best for you. And well. Sorry, long answer.
No, that's a good point, actually. So if a founder comes to you, would you advise them on which is the best vehicle for them? Like, is this something that it's part of your service and from the partnership and supporting the company?
Say it again, because I didn't get this one. What's the question?
I think that the question is like whether if that's something that you guys provide to the founder. So showing which are all the available...
You have to, because the guys are coming to you, say like, I need money. It's like, okay. What for? And then you say like, okay, I need for working capital. Perfect for that. I need to open a new market. Not good for that. So you have to guide them during all this time and say like, what is it for and how to structure it. Because the most important point that many founders realize is like, they are a bit afraid of that because it's getting complex. So you need to have a good CFO if you're not a good financial guy as a founder, which mostly is not the case. And then you really have to look into detail. But at the same time, it shows also that you have discipline and it helps also to raise further equity rounds. Because once you raise a venture debt, you have to have like some kind of financial discipline. You have to show the numbers, the revenues, everything in a certain way. And after a while, you realize that you can much better show it to your VCs and much more credibility, etc. So I think that has to be part of the capital mix at some point.
And it seems that also generates trust with the founders that you back.
Of course, yeah, because we are all in the same boat. Doesn't matter if it's equity or debt.
Yeah, absolutely.
No, this is key, so I may add. So, I mean, at this stage, these kind of companies, you need to be advising them. So the worst thing you can do is to enter in a debt product when you are not ready. So this is a lose-lose situation, and it's a lose situation for the provider, for the bank, the fund, or whoever is providing the debt, and for the company. So if this, for whatever reason, is not ready, you have to have this frank, direct, and transparent conversation. Right now, you need equity. You need to prove these points. This is what you need. And 2 years, 1 year down the line, I'll be there.
Okay. The three of you are analyzing hundreds of companies constantly. I would love to understand what makes a fundable company for you. So could you please each give maybe like let's think about it as a green flag and red flag. So Ignacio, maybe you can start.
So, I mean, for me, and this is also personal, the greenest flag for me would be predictability, reliability. I mean, you need to trust these guys that they are going to deliver, because this is coming to my first point, that you are working with companies that they don't have that much historical track record. And also what I would call capital efficiency. So if you are a guy that are able to do a lot of things with little, you are my guy. So this would be the green flag. And on the other side, obviously, a red flag for me is, I mean, there is a say on there that you don't solve equity problems with debt, which means basically that you are always, I mean, I don't like the kind of companies that say, I just only need this little piece of debt and I will be self-sustainable. It's just a matter that I'm not finding the equity. For me, I mean, this is also my playbook. Debt is following the equity. It's not the other way around. So
You mean the bridge rounds, right? Bridge rounds.
In essence, bridge rounds, this kind of stuff, is the kind of things that it can work, it cannot work, but I'm not willing to take this binary bet.
What are bridge rounds?
Bridge rounds could be this kind of round where you are lending to a company where the takeout, the repayment is coming from an equity round that they are working on. So you are just extending this runway in normally, and this widely depends, situations where there is some kind of problems, meaning that the cash is getting short and you are not delivering as you would expect because you have cash problems. So in that case, it's an account that you are not negotiating in a position of strength, which is very important when you are talking out with VCs and other equity providers.
Thank you. John, green
Yeah.
and red flag?
So green flags, I think there's many green flags. No, for us making a debt decision, no, you need to have a great management team. You need to have high growth. You need to have strong unit economics. And so there's many factors that we look at. Red flags, I would say, especially today in the age of AI, where creating software, creating content has become way cheaper than in the past. There's going to be a huge disruption of the whole economy, of many companies, of many different business models. So with that in mind, I think a key red flag is that if the company doesn't have a moat. So I think it's super important that they have a sustainable competitive advantage, which will allow them to survive in this age where building new businesses has become much cheaper. And so that sustainable competitive advantage can be a very strong management team that is able to adjust, to build, pivot towards a successful business model. But it's also ability to either have proprietary data, ability to generate their own proprietary data, ability to generate a brand or have a strong brand, have strong customer relationships. So you need specific factors that give you certain protection and allow you to be competitive in the foreseeable future.
You mentioned that you had a lot of green flags, but you didn't tell us which
Red flags, actually.
which were those. So give us 1, 2, or 3 of your multiple green flags.
So one red flag for me would be if the company doesn't really have a competitive advantage. Now, if they have a business model which can be easily copied, or if it's a software where there can easily be tomorrow a new guy creating the same and attacking them.
And the green ones?
And the green ones is management team, is high growth, is unit economics, is and having a strong equity behind them, strong equity partners.
Okay.
Well, I think it just comes about money, how you make your revenues and how sustainable they are. It's true. We analyzed billions of euros of venture debt and ABLs. But it always comes down to how credible is it that this revenues are going to sustain, going to grow more or less in the past. And there's lots of things coming into place, like the guys were saying. It's a management team, how they did it until now, the traction, general traction, and very important, I think, for us as a fund. We have over 850 million under management now. It's who is actually behind as a sponsor, who is the VC behind. We have very close connection to everybody. We talk about, in detail how each company is doing all the time. So in terms of green and red flags, there's much more red flags than green flags because you're debt anyhow. So you have to look at much more things. But especially on the AI question, which is interesting, it's part of our investment analysis, of course, to have the AI threat. But we look at more AI opportunity because we see that most, or pretty much everybody in the portfolio is actually using AI in order to reduce the cost. And this is one of the things that if they don't do it, that's for me a red flag. Especially now in the last 1 year and a half, it's just amazing how things are changing. Then red flags is the single most, the biggest red flag for me is like, when are the guys coming to us for that? Really, it's that. If they have like the bridge round, I mean just to make it even shorter, it's like you get that in order to have a bit more longer runway, in order to raise more equity, okay? So why? Because you don't want to take the equity from your equity investor, because the equity investor doesn't want to give it to you, whatever. But if you have just 3 months left, do not come asking for that, because it's very strange. It's like a huge red flag for us. Like, why? Why would you do that? Just go to your equity investor for 3 months more, give them another, get another 6 months, prove your point, and go on. It's not really right. So for me, the runway is really, really important. I think you guys said exactly the same thing. But at the same time, as it is venture debt, we're looking at the same thing that the venture capital is looking at. So team, traction, everything, moat, right? So it's a bit more complex than that. So I don't know, it's very difficult to pinpoint in 1 or 2 green or red flags. It's a whole picture. But generally speaking, please get that more or less when you get equity at the same time. If you have to do a bridge round, go to your investor and say, give me 500K because I'm going to get another 500 from Christy, Jan, or Ignacio. So whatever, or millions. Actually, we didn't even say what our ticket sizes are. Didn't ask.
Please go for it. We start by you.
I know, yeah, so we're doing between 3 million in venture debt to 50 million. In ABL, it's like really open-ended, so it can be more throughout Europe, actually, so not only Spain.
You, John?
For us, venture debt, we can do tickets from 1 to 2 million up to 20 and above. Pretty wide range.
So it's kind of tough question because normally we can do wherever we want if there is a sense to do that. So we don't normally go as little to below 5. But it is true that we can go above 100 if we involve all the other, also asset-backed lending or capital market, what we call capital market strategies, like one transaction that we did some days ago. So, I mean, the key thing on our team is, and you mentioned it already, so what is the use of proceeds and why you need this amount? So if this is, in our view, accretive, probably we will find a way to go as big as you need to. Obviously, there is always back and forth on this discussion. If there is no good excuse, probably we will go, so just add some equity, some debt, and let's find a hybrid solution.
You guys are the ultimate experts on what you do. And the best way of avoiding making mistakes is to learn from the people that have already figured it out. So what is a common mistake that you see founders do that it's very easily avoidable?
Okay.
Nothing else?
As always, good questions. I mean, I don't like, in essence, we are talking about the market, and sometimes markets can be irrational. So sometimes we find out situations where you meet companies that for whatever reason they've been able to raise more debt than they are capable to repay. So in this over-leveraged situation, you are facing kind of, let's say, not a minor problem. Because if for whatever reason your projections, and this is very, let's say, forward-looking, and these hockey stick projections are not working as you expected, and you have debt, and more debt than you can handle in your capital structure, this is a situation that can be kind of a vicious circle, meaning that probably the equity guys are going to be very conscious on why should they be investing in this business because they are going to sweep all my equity, why it doesn't make sense, I can buy this company much cheaper, you don't have bargaining power to discuss. So I would say be careful to deal in debt transactions when you are not ready. Probably sometimes, even if there is this crazy market, when you are able to raise it, be careful because sometimes the cycles change, and when the cycle changes, you have not delivered on what you were pricing to perfection, you will probably have a problem that is not easily to be fixed. So probably this is a typical problem that I have seen in many situations.
Dan?
Yeah, I totally agree with the answer of Ignacio. And maybe adding to that, I think it's super important to have one, optionality, and second, to choose the right partner. So it's a bit like dating, no? When you're looking for a new partner, I think first you try to meet lots of candidates. No, you work the Tinder, you meet many potential girls, boys. You really get to know the market. You have to know the market. You have to know what's available.
I usually just go in one bar, man.
I'm a married guy, so don't look at me.
But then you make a mistake. So you have to know the market. You have to know what's out there. You have to know what's available for you. But then you have to do also the due diligence. Not go with the first, like the most beautiful a guy or girl you meet. But you have to do your due diligence. Speak to people that already did business with this company, get feedback, and because choosing the right partner is super important. Because in the end, whether you sign debt or equity, startups, it's never a straight line. There's always difficult situations. So I think it's super important that when there's difficult situations, that the partner that you chose is able to basically continue supporting you through that journey. And either maybe giving you additional capital, maybe giving you a little more flexibility when you really need it. But it's super important to choose the right partner.
Well, what I see actually in pretty much all deals in the last years is, partner, right. It's really true. The only thing is the partner has to be able to be flexible enough, and I see that companies, CEOs, founders, they put much more value on the flexibility of their partners, which just means like how probable is that the VC is going to give you more money if you hit the bump in the road. How probable that you change some covenants in your venture debt or ABL or whatever you're doing. And this is really one of the most important points, I think, that it's crystallized actually over the time. We thought, when I was with you guys, we always thought like pricing is important, whatever. It's actually not that much. It's more flexibility because you don't really care if you pay one, as a founder, I see that they don't really care if they pay 1 or 2% more or less. What is important is that they hit a bump in the road, which they will for sure, then they come and say, hey, Christy, can we just restructure a couple of things, do something more, maybe you win more money at the end, whatever, something around it. And some players are able to do it, and some other are not at all. So this is why there are funds out there who don't negotiate. There are banks out there who do negotiate. So it's just like, you really have to know your partners and listen who's out there.
Thank you. We have 5 more minutes for questions. Does anybody have a question for these 3 amazing gentlemen?
Amazing. Yeah.
You would how do you have to select the program you're gonna follow and with whom to follow, in your opinion, if you want to develop your fintech platform?
A program of what exactly? Is it a program to
mentoring,
acceleration,
mentoring,
type of thing?
And maybe it can be related to your investment profile that you're gonna require for your company.
Well, that's a tough one because it's very early stage. This mentoring part is really important at the beginning, right? So there, you don't have that much debt really, neither. You have more equity. So what you need to do is find a good equity investor, and he is going to guide you, or she is going to guide you. at this point. I really don't think it's so much us. And well, the Visa program is amazing. MasterCard has got one. American Express, I think, have got one even. So there are quite a few out there. And if you're doing lending, you have to talk to more ABL guys, like asset-backed lending funds, and they will guide you as well. You need people who are guiding you in each stage, and this right stage for your early stage, or for this early stage example, is not that.
How do, yeah. Okay, hi. And how do you select the person you want to follow? Because it's very important in the early stage.
It's not selecting. You have to pitch it yourself, and somebody has to accept you, because there's so much out there.
Okay.
I'm sorry. It's difficult to. I mean, how do you do it? Like, I would just go to the ones that are closest to you, that did similar investments in companies like yours, and just try to talk to them, try to pitch them, and say like, hey, even if you don't invest in me, can you guide me? And they will do it, even if they don't invest. They definitely do, because everybody's super friendly ecosystem. I mean, we are competitors, but we're all nice to each other, right? So there's no problem whatsoever. And everybody here wants really to help founders. So.
Is there anything else, like any last message that you want to share with the public? It's okay if you say no. Don't feel pressure.
Go and no. If you're Series A plus, come to us and we talk about that, right? If you want equity, actually, we also can guide you in the right direction, to be honest, because we know quite a few people. So yeah, hopefully you're going to have lots of success, guys.
My message, I mean, quickly, I mean, that's a piece of advice. So be serious with the numbers. Probably it's not very popular to say this, but try to work in numbers that financial investors can understand. And I think it's an investment, and that it will be repaid on itself, maybe not now in the short term, but definitely in the medium to long term. So that's my 2 cents over there.
Thank you so much. Thank you so much, guys. And
Thank
thank you
you.
for everyone for coming.